No, Virginia, there was no Santa Claus rally. For those who waited with high anticipation for the markets to boom in December, well, let's just say 2022 is going to be a year that lives in infamy. This is Steve Wolf, and it's currently January 5th, 2023, and it's time for our wrap-up of December of 2022 and actually the whole year of 2022. Well, as they say in the neighborhood in which I grew up, oy vey. What a year. A bad December helped to make 2022 the seventh worst market since the 1930s, according to Action Alerts Plus. The S&P 500 index had its worst year since 2008. But, I've got tons of good information here. Before I get to that, let me get this out of the way. Whatever's being said here is for informational purposes only and is not meant to be a recommendation. So before you buy or sell anything related to anything I'm saying about the markets or individual securities, be sure to consult your financial advisor to ensure it's the best recommendation for your personal situation. Okay, now let's get to some sobering statistics. According to TheStreet.com, for the month of December, the S&P was down 5.9%. The Dow was down 4.17%. The NASDAQ was down 8.73%. And the Russell, the small cap stocks, were down 6.64%. Now, that was just for December. For the whole year, the S&P was down about 20%. The Dow was down only about 9% because there's more value stocks rather than growth stocks. Growth stocks are the ones that got hit. NASDAQ was more growth stocks, and that was down about 33%. And then the small cap index was down about 22%. Well, here's some more sobering statistics. According to Morningstar, 36% of U.S. stock funds, which began prior to 2021, had their worst year ever. Think about that, 36%. And of the growth funds, 40% of the growth funds had their worst year ever. That is bad. And it was a bad year. The bear was firmly in charge, and the bull just kind of rolled over. And hopefully he'll wake up someday. But for right now, I don't think that's going to happen. So what about volatility? It was a volatile year in 2022. And if you take a look at the chart, and I'll tell you something, 2022 probably made you nauseous from all the volatility, and I don't blame you. The indices, not only were the indices down, but the volatility was way up. Take a look at the chart that was supplied here by J.P. Morgan. And if you take a look at the colors here, the green is the S&P 500, the blue is our interest rates, and the dark gray is our currencies. And on the bottom, you can see the years 07 through 22. And you can see that after 2011, we had almost no years where volatility was higher than history, except for 2020 when we had the COVID crisis. But if you take a look at all the way on the right, you can see last year, S&P, interest rates, and currencies were all much higher than the normal volatility. And it was tough. I mean, we'd have down days and you'd have up days. And actually, since about June, the market's gone kind of sideways a little bit, but just doesn't feel that way because there's been so much volatility. Now, let's take a look at what kind of makes this all up. All right. I'm going to show you a chart of the style boxes. And what that shows you is large cap stocks, small stocks, and mid-sized stocks, and whether they were value or growth or a blend of those two. Now, if you take a look at the chart itself, and you look at where it says 2022 on the right over there, and you see large and growth, and put that box together, which is your top right, that particular area of the market was down 40.4% last year. That's a big number. The mid-cap growth was down 32.4%, and the small cap was down 33.1%. Now take a look at where the value stocks were. The large cap was basically even, which was unbelievable. The mid-cap value was down about 6.6, and the small cap value was down 2.4. So obviously, value stocks were the place to be in 2022. And for those of you who have both the dividend income portfolio that we run and also the growth portfolio that we run of the individual stocks, you could see that right away. I mean, there's a stark difference between the performance of the two. The dividend income fund held up fairly well. I mean, I think it was down in the area of around 8%. And the growth portfolio just got crushed. It was down in the 30% range, 35% range. So a stark difference between the two. All right, well, now let's take a look at bonds. Usually bonds in a portfolio keep you balanced. So when the stock market's not doing well, hopefully the bonds, and usually the bonds, are doing okay, so you're not getting beat up quite as badly. But the bond market had one of its worst years ever. So really there was no place to hide. There were actually a couple places to hide. One was cash and one was the energy sector, which was about the only sector that was higher for the year. Everything else was pretty much down. But if you take a look at the chart of the largest bond funds in their worst years, you can see that 22 was really terrible. There was the Vanguard Total Bond Market Index, the PIMCO Income Fund, the iShares Core U.S. Aggregate Bond, American Funds Bond Fund of America, and Metropolitan West Total Return Bond Fund. The red shows this year, and the gray shows their previous worst year. Every one of those was worse than their previous worst year, with the American funds just slightly worse. But Vanguard, PIMCO, iShares, Metropolitan West, they all had bad years. 78% of U.S. bond funds that were incepted prior to 2021 recorded their worst year according to Morningstar. 78%. 147 of the 150 intermediate core bond funds had their worst year ever. Now, why that happened is because interest rates going up causes bonds to go down in price. That's exactly what happened. Now, here's another chart by Morningstar. It's the 2022 Market Performance Barometer. Now, we all knew how tough the U.S. stock markets have been, and you can see that the international emerging markets were also down. The developed markets, ex the U.S., so without the U.S., down about almost 15%. The emerging markets were down almost 18%. But now take a look at the fixed income markets. This is most unusual. The U.S. core bond, treasury bond, U.S. high yield bond, and TIPS were all down somewhere between 11 and 13% for the year. But if you were in a long-term U.S. treasury bond, oh boy, you got hit hard. It was down almost 30%, 29.45. You can see that on the bottom right. That was a 10-year plus treasury bond. And again, that was because interest rates were going up. Of course, with interest rates going up, what else was affected in 2022? Well, mortgage rates. And according to Freddie Mac, mortgage rates started the year somewhere around the 3% range and ended the year somewhere around 6.5%. So if you wanted a mortgage, it cost you a heck of a lot more at the end of the year. Matter of fact, it peaked in November at about 7.1%. And of course, what did that do? That has had the effect of slowing the housing market. There was a time in the beginning of this year, or the beginning of last year, actually in 2022, where you had people just climbing over one another to try to buy houses, and the market was red hot. Well, once interest rates really started going up, it has slowed that real estate market down. How far exactly, I don't know, but I know it is definitely slower. And if interest rates continue to go up, it still could have another effect on that. So let's take a look at another chart. This is everybody's favorite over the last couple of years, and that's cryptocurrency. Now, this is the Yahoo Finance cryptocurrency chart of Bitcoin and Ether, which is for Ethereum. And I think that the chart says it all. If you take a look, the gold or brown line is the Ether line, and the blue one is Bitcoin. And from January until about June and July, the Ether line was down, or the Ether coin was down about 72%. You can see that in the chart. Bitcoin at its low, which is around now, is down somewhere around 65%. So if you were in cryptocurrency, you had a big problem. And of course, we also had the news with that FTX going bust and all the things that are going on right now with that trial. And we'll see what happens there. But that, of course, didn't help the market either. That hurt a lot of companies. What were some of the causes of what happened? We talked a little bit about it. The Federal Reserve was trying to tame inflation. And of course, what they were doing was they were raising rates aggressively. This is about the fastest I can ever remember interest rates going. And if you take a look at the chart that we've got that was provided by Forbes, and it's got the FOMC meeting date on the left, and then in the next column is the rate change. So March 17th, the Federal Reserve raised the rates by 25 basis points, or 1/4 of 1%. And then in May, it was 50 basis points, or a half a point. Then in June, July, September, November, it went up by 0.75% each time. And then in December, another 50 basis points or a half a point. That total is 4.25% up. And, that doesn't sound like a lot, except that it started the year the rate was at 0.25%. We are now at 4.5%. If my math is right, that's about an 18-fold increase. That's a huge increase in a very short period of time. That velocity, that increased velocity, really hurt the markets. And the higher that these interest rates get away from that zero mark, the more that especially growth stocks had to be re-rated. So that's what happened during the year, that investors were saying, well, how much do we pay for a dollar's worth of earnings? And as, of course, you've seen, obviously it's less than it was a year ago. Now, there were some other things that happened last year that also hurt the market, and that was the war in Ukraine, which, although oil prices were already coming up, it made it worse. So with oil prices going up a lot, that hurt inflation. And of course, the supply issues that have been caused by COVID are still around. Take a look at the chip companies, and they've been really hurt by what's happened with the supply chain. All right, so the outlook for 2023, what's that all about? Well, unfortunately, the market does not have a calendar year, okay? It goes by its own calendar. So sometimes a good market will start in the beginning of the year and end a year and a half later, or 3 years later, or 5 years later. Same thing with a down market. The down market doesn't go by January 1st to December 31st. But that's the way we like to analyze things. So here's some good news from Yahoo Finance. So the index rarely loses in 2 consecutive years. That's only happened 4 times in the history of our markets, at least dating back till 1928. And of course, those 4 times, you might be able to guess them: the Great Depression, the start of World War II, the oil crisis in the 70s, and the dot-com bust in late 1999, early 2000s. So, and just in case you're wondering, Yahoo Finance also said that the S&P has only dropped 3 years in a row, twice since 1928. And you can probably guess that the dot-com crash and the beginning of World War II, it went 3 times. And then 3 times in a row. And there's only been 1 time in history where the S&P index has gone down 4 years in a row. And of course, that was during the Great Depression. I don't think we're anywhere near that. Companies really aren't doing that badly. We've got a lot of bad news out there, political stuff, whatever. There's a lot of bad news out there, but it's not anything like the Great Depression. So I'm not really worried about that. But what do I think is going to happen? Here's my prediction. We'll see next year at this time. We'll see if I'm right. I think the first half of the year is still going to be rocky. And why do I think that? Because I don't think that the analysts have got their earnings projections down enough. I think that in this first quarter, and it'll be interesting to see in the first quarter of the year, if earnings have really dropped a lot more than what the market has already anticipated. If it has, then the analysts are going to have to lower their ratings and lower their projections. And if that happens, I think you're going to see the market get hit a little bit more. And again, it's probably going to be the same culprits. And I think that the Fed is still going to increase rates, at least for a while. I'm hoping that they're not overdoing it, because just today I'm seeing a lot of companies starting to lay off people or freeze hiring. We haven't seen that in a while. It started a little bit last year, and that's ramping up. And I don't think that the Fed wants to get us into a severe recession. I'm not even sure they want to get us into a recession. They do want to stop inflation. And by the way, that also brings me to another point. Part of their problem, too, with getting inflation down is fiscal policy. It seems like they're at odds with one another. The Fed is trying to contract the money supply and contract what we do in the economy, while the federal government keeps adding more programs and spending more money. Now, this isn't the first time that the federal government spent more money, but they need to get in sync, or it could take a little bit longer to get out of this malaise. So we'll see what happens. I mean, again, first 6 months I think are going to be rocky, but I think the good news is I think that by the middle to the end of this year, and I'm betting on the middle of the year, I think things are going to settle down. We'll reach an equilibrium point. I think that the markets will then start rallying a little bit. And if the Fed ever lowers rates, I think you'll have a super rally. So I think it's going to be a little bit rough. If you need some money, again, to get through this, make sure you take some money out of your accounts in cash. If you already have cash, that's probably a good place for some safe money. One of the nice things that's happened about interest rates going up is there's finally income in fixed income. In other words, before, if you wanted to have a CD or even a money market, you couldn't get anything for that. You're making 0%. Who wants to do that? Which one of the reasons that the stock market was up so much. But now, there are money markets that are getting you 3, even up to 4%. The Treasury bill is up to somewhere in the 4 or 4.5% in the short-term rates. As a matter of fact, even closer to 5%. So for a resting place, that might be a good place to be. Or for some people that want to go maybe a 60-40 portfolio, it might be a permanent place for some for some people to be. So you got to take a look at all that. I think this year is going to be an interesting year. So that's what happened in 2022 and in December of 2022. I will be back here in February to recap what happened in January. So until then, happy investing.